a large fraction of total carbon emissions therefore stem from buildings, and the built environment offers one of the largest potential sources for greenhouse gas abatement, and perhaps that even comes not at a cost but as a benefit, because saving on energy actually also means lowering your outgoings, and those outgoings in buildings on energy can be quite significant. If you think about the total operating expenses in a typical commercial office building or retail, about 30% goes to energy. 10% of total housing costs, and this is an average across the US, is actually spent on electricity, steam, gas, and perhaps even heating oil. The total cost on an annual basis in the US is about $400 billion. So significant energy consumption in buildings, but also significant energy spent. And the awareness of this is growing. It's growing really because energy efficiency is a good business case. Very often it leads to returns that you can only dream of as a real estate investor in the current environment. We're seeing a growing awareness among companies that look from their corporate social responsibility policy to rent or lease and buy more sustainable space. And then we see legislation coming into place when it relates to energy efficiency. And that legislation is important because it's going to be very hard to avoid. And I want to spend a couple of minutes on that. Because if you think about it as a policymaker about how to reduce the carbon impact or the energy consumption in the built environment, there's a couple of things that you can do. As a politician, you could raise energy prices. Well, that's typically not a very popular thing to do, but we've seen some cap and trade schemes. For example, California, Europe was an early adopter with a not so successful scheme. The UK has the carbon reduction commitment, and Australia had a cap and trade scheme, but that has been actually phased out by the new government. So raising energy prices through cap and trade is the first best solution, but that doesn't really happen a lot globally. Now, stricter building codes and subsidizing retrofits will be another very efficient way, or hopefully efficient way, to reduce energy consumption in buildings, but it takes a very long time for new constructed buildings to replace the existing stock, and as it goes with subsidies, they come and they go. And last is the stimulation of market efficiency, so getting investors to invest in energy efficiency through creating transparency. And that transparency is what we're going to focus on today. Transparency can be energy labels or can be green labels, and presumably by providing that information to investors and to tenants, they'll make choices for more sustainable buildings once they know what the implications of their choices are for their outgoings on energy consumption. And presumably those labels are going to lead to differentiation in energy costs and ultimately rents and prices on buildings. Now, what's important in the United States, there have been two, you could call it green building programs or energy and sustainability programs for almost 10 years, or for a bit over than a bit more than 10 years. The first is EPA's Energy Star for commercial buildings, and you might know Energy Star if you look at your computer. There might be an Energy Star logo on it, the same one that you see on slide 7. But what's important is that Energy Star actually broadened their labeling scheme to commercial buildings in the end of, or at the end of the 90s. So for about 15 years, there have been Energy Star labels for commercial buildings. At this point, 26,000 buildings, almost 4 billion square feet, have been certified under EPA's Energy Star. And what's important is that you can only obtain such Energy Star certification if you're in the top 25% of most efficient commercial buildings, whether it's office, it's retail, or other property types. What the Energy Star program actually does, it looks at your energy consumption, standardizes for weather, for occupancy, both in terms of number of employees as well as hours, presence of trading floors, server farms, etc., and then compares that standardized consumption in your building against a benchmark called CBEX. And without going into too many details, that stands for the Commercial Building Energy Consumption Survey, comparable to a census, to the census as we know it. That comparison gives you a score from 1 to 100, and if you're 75 or above, You can go to a certified professional engineer, he'll look at the data, he'll look at the building, he'll sign off, and you receive a plaque that you can put in your lobby or put anywhere where you would like it. So what's important is that the Energy Star label is based on real energy consumption, and it's focused on energy and energy efficiency only. Now, there's also a broader labeling scheme, and that's called LEED. It stands for the Leadership in Energy and Environmental Design. Was introduced also at the end of the 90s. And as of a couple of weeks ago, 23,000 buildings in the US had been certified under the LEED program, and that's about 3 billion square feet. So very significant amount of space. And what's important is that LEED is broader than energy alone. So it's a scoring system that's based on 6 components. Energy is one and an important component. There's also materials that are used in the building, how the building is actually being managed and cleaned, the location of the building relative to public transport, water efficiency, renewable energy, and other components are included in that more broad-based sustainability label. This label was based on the design stage, typically. That's for new construction, but LEED for existing buildings, which is also one of the versions, actually requires you to have a certain Energy Star score, and recently in the latest version, that Energy Star score is actually 75. So you could say that LEED for existing buildings are typically also efficient buildings, and LEED for new construction, those are buildings that have been designed to be existing buildings. Now, for the international attendees here today, that includes myself, similar schemes exist internationally. So BREEAM is a label of choice in Europe. USGBC, that's a French label. DGNB, a German label, where you can kind of continue and go on and on. There's about 150 green labels worldwide. That said, LEED is the most widely diffused green building label worldwide, and Energy Star is the most widely used green label in the US. And what we set out to do, and we started this last year for the first time, is to look at the adoption of green building space in the US market. Because whether you're in New York City or whether you're in Chicago or in San Francisco, you might have seen those flags on buildings that say LEED certified or Energy Star certified. So we all know examples. But the big question for market participants, so think about institutional investors, think about occupants, think about managers of buildings. Their big question is, how important is green building really in the US commercial property market? And that's an important question to ask because, you know, maybe you want to be in that space, maybe you want to invest in LEED certification, or maybe not, and you want to make those choices based on good information. So what we did, and what we started last year, and what we did for the second time this year, is we set boundaries for the 30 largest markets as defined by CBRE. And those markets include, well, the markets that you know. So of course, there's New York, and there's San Francisco, and there's Chicago, and there's Boston. We'll show you more markets. And we looked at all of the commercial office buildings in those markets. That's quite a few. We'll show you that in a second. And then what we did, we looked within the boundaries of those markets, and we looked at all the buildings that were labeled as green in those markets. So we looked at the LEED certified buildings, and we looked at the Energy Star certified buildings. And in that way, we can actually track the diffusion or the adoption of green building space per market, and we do that from 2005 until 2014, so for a period that both precedes as well as includes the financial crisis. There's a couple of things of note that I think are important that you should know. We only look at LEED and Energy Star. We only look at office. We only include buildings that we consider what I call liquid office space. So we do not look at buildings that are owner occupied or that are government occupied. We do not include buildings that only have LEED for commercial interiors. So LEED has one version where as a tenant you can do a fit out and certify that. Well, if you do that, that's typically only part of the building. So we don't consider that as a LEED certified building. And then importantly, especially for the results that I'm going to show you, is that we say that labels have a certain vintage. So imagine that you constructed a building in 2005 and you got a LEED certification for that. That's by now 10 years ago. Or you got an ENERGY STAR for your building in 2010. Well, that's by now a while ago. So we have a label vintage that we apply to the building labels. And we say that label vintage is 2 years for ENERGY STAR and it's 5 years for LEED. For LEED, that's also something that has been set by the US Green Building Council. For ENERGY STAR, it's something that we have set ourselves. And we've played around with different vintages, but we believe that 2 years is the right proxy or the right length for a label still to be valid. So important, if you were labeled in 2014, we include that building as green. If it was labeled in 2013, we still include the building as green. If it was labeled in 2012, we no longer include that building as green in our data set. So if companies, if investors do not recertify buildings on a continuous basis, we might see a drop in the adoption of green space. Now, we have the market itself, we have the denominator, we have the numerator, which is the green space, and then we look at two ratios. We look at the number of buildings that has been certified, and then we look at the square footage of space, because we believe that size may have an influence on the adoption of greenness. We get all the information, so here are the caveats, from CBRE research on the markets, and we get the information on green buildings from the US Green Building Council, and that includes the ENERGY STAR data. So without further ado, that's the long introduction. I'm going to take you through some of the results. These are the high-level results. The official report will be out early next week, so make screenshots, tweet about it, because this is the sneak preview. Here are the results for the adoption of green buildings over the last 10 years, starting 2005, ending the last quarter of 2014, so December 31st, 2014. It doesn't get more recent than that, sadly. What we see is a significant uptake of LEED and ENERGY STAR over the last 10 years. In the dark green line, and I hope you can distinguish the two, that's the lower line, you see the adoption of green buildings by number of buildings. And in the light green line, you see the adoption of green space by the square footage of buildings. So there we look at the stock of space measured by square feet. What we see in terms of numbers is that the number of buildings designated as green by LEED and ENERGY STAR was 1.5% in 2005, and that has grown to 13.1% at the end of 2014. That's what the lower line tells us. However, and that's very hard to see in this table, this actually went down from 13.8%, so went down with a bit more than 0.5% over the past year. So the adoption of green building space actually seems to fall. We're going to dig into this in a bit more detail. If you look at the line on top, in 2005, 5.6% of buildings by square footage were designated as green. That has grown to 38.7% or 39% by the end of 2014. And that number has also come down from where it was last year. So let's look into LEED and ENERGY STAR separately, because that's where the curves are quite different. If we look at ENERGY STAR, and that's what you look at right now, we see that ENERGY STAR quite clearly is flattening out, and as a matter of fact, the adoption of ENERGY STAR actually seems to go down slightly. This is easily explained. And by design, ENERGY STAR certification for buildings can only be a max of 25% of the buildings. If we look at ENERGY STAR by floor space, we're now at 27.8%, and that decreased quite significantly from 31.7%, so almost 4% since last year. So the adoption of ENERGY STAR seems to decline quite significantly. It's also driven by the fact that we no longer include a building if it hasn't been certified over the last 2 years, because a building could have new occupants, could be managed in a different way, and we want to be certain that the building is still an efficient building. In terms of number of buildings, we still look at almost 10% of the total US commercial office stock that has been certified by ENERGY STAR. The story for LEED is a little different. The story for LEED is that the LEED uptake until about 2008 was there, as you can see in both these lines. And LEED started very low. 2005, it barely existed. 0.1% of buildings was certified, 0.4% of square footage. That exploded to 20.3% of the square footage certified, of the total office square footage certified by the end of 2014, and that's about 5% of the buildings. So what this tells you is a couple of things. First of all, large buildings are more likely to be certified, and I'll have more details about that on the next slides. What we also see quite clearly is that LEED is flattening out, but it's not decreasing yet. So last year, what we see is that 5.1% of the total U.S. commercial office stock was certified by LEED. That's now 5.3%, small, but it's an increase. And on square footage, we went from about 19% to about 20% in 2014. LEED can be broken down into different programs. And I mentioned LEED for existing buildings, LEED Core and Shell, and LEED for new construction. Those are the three main programs that LEED offers. And what you see is that since 2008 or end of 2008, it's really LEED for existing buildings that has caused or driven a lot of the growth. And what you look at right now is the percentage of buildings certified. And on the next slide, I'll show you the square footage. So at the end of 2014, about 3% of the buildings in the US LEED for existing buildings, and about 1% both for LEED Core and Shell and LEED for new construction. By percentage of number of buildings, that's fairly small. Now, if you look at the percentage of stock, that percentage is more significant. 16% of all the space certified by LEED for existing buildings, and slightly under 4% certified under LEED for new construction or LEED for Core and Shell. Here's the summary on slide number 14. You see the increase from 2005 till 2014. That staggering increase, total square feet from about 6% to 39% between 2005 and 2014. But underlying that is a clear and undeniable trend that the uptake of green building seems to slow across the US. That's important information. It's not necessarily bad news, because by design it would be very odd if all of the US office space would be green certified. We would have to invent a new metric. And what we see really is that there's going to be more competition for buildings to stand apart, because large fractions of the space have now been certified. What we then do is we break down buildings and how big they are. So we say, well, if you're a building under 100,000 square feet versus a building that's over 500,000 and then everything that's in between, how does that affect the uptake of green building? So in this table, and I'm going to be adventurous here, and I think there's a way that I can actually show you. There we go. In this table, and I hope you can see that if you're logged in. If you look at the buildings that are smaller than 100,000 square feet, only about 4.5% of those buildings are green certified. Now, if you look at the buildings that are larger than 500,000 square feet, so 500,000 square feet, those are big buildings, 62% of the buildings are certified. And that holds really, whether you look at Energy Star or whether you look at LEED, it really holds across the board. So for example, for LEED, small buildings, smaller than 100,000 square feet, only 2% of the space has been certified. And if we look at real big buildings over 500,000 square feet, we look at about 51% of the buildings that have been, of the space that has been certified. So size matters strongly when it comes to the adoption of green space, and it's the large buildings that are being certified first. All right, now we get to the next step, and that's what is the greenest city, at least from a commercial office market perspective, in the US. Here's the preview of the outcome of this year's ranking. Minneapolis-St. Paul, maybe surprisingly, is the greenest city by percentage of buildings that have been green certified. And we look at square footage here. 70.4% of the St. Paul, Minneapolis office market has been certified by either LEED and or Energy Star. And that's trailed only by 40 basis points or 0.4% by San Francisco, and quite far behind it is Chicago, still at 63%. And you can go down the list and see some of the other cities where green building adoption is quite high. Now, these are the top 10 greenest cities, but obviously we can also look at the laggards, and we call these green challenged cities. The bottom of the list is Kansas City, where by square footage, still about 11% of the total office stock is either LEED or Energy Star certified, followed by Stamford, Pittsburgh, Milwaukee, New Jersey, Detroit, and as you can see, those cities have something in common, and Dave will talk about it in a moment. First, what we're going to talk about is San Francisco. I'm going to hand over to Dave. I'm the semi-academic. Dave's the market expert. Talk a little bit about San Francisco and those market dynamics. Dave?
Thank you, Niels, and good job on kind of running through all this dry stuff. So I get the fun stuff. One of the things that we wanted to do in the study was to focus on those cities, frankly, that were the best. And what we've done in the study, and it'll be released publicly and fully the first part of next week, we have done an evaluation of each of the 30 cities that are in the model. And we give rationale and reasons of why. We also give some very specific details about green leasing and sales, et cetera. So I think that's one of the more interesting pieces of this. But I wanted to highlight two of the cities, just to give an example and to kind of compare and contrast a city that really has adopted this and a city that hasn't. And so the city I picked that has adopted is San Francisco, partly because it's kind of where I'm from, and I understand the dynamics a little bit better than I understand Minneapolis, but also because it is a city on the rise. Last year, they were number 2 by about 4.5 or 5 points. This year, they're number 2 by only 0.5 point, and they continue to grow the green space there. And so here are the reasons, and we've spent a lot of time trying to understand why do particular cities adopt these things faster than others. And if you look at the characteristics that we've identified here for San Francisco, they basically have almost all of them. First of all, it is a first-tier coastal city. And if you look at the list of the top 10, they are almost all in that category. First-tier cities, global cities, destination cities, and many of them are bi-coastal. Secondly, and this becomes important as well, the city of San Francisco, by and large, is a community that is committed to good environmental practices. If you look at even the things around recycling and the fact that there are wet trash recycled compost requirements of the city of San Francisco, more than 80% of the waste is diverted, and all those kinds of things that are there. It's just the population base cares about this, so they have a community support and demand for it. They also, in the city of San Francisco, have green building regulations mandated as part of building requirements. Since 2012, new buildings, even new interiors over certain size space have to be built to LEED gold levels. Also, San Francisco obviously is in the state of California. The state cares a lot about this, and there are some regulations at the state level. AB 1103, which I think is not terribly onerous, but also Title 24, which the state of California has had in place for many years. It's just been updated and made even more difficult, some would view. So as the state also is concerned about it, and there are regulations that push this forward. There also, because it is a global city, a first-tier city, there is a very globally diverse institutional ownership. And I mentioned earlier, and Niels was the founder of the Global Real Estate Sustainability Benchmark, the GRESB survey. This is that survey that looks to understand the characteristics of fund managers, and there's a lot of money around the globe that is interested in real estate, but particularly interested in real estate that is sustainably owned and managed. And so if you have more global clients, more global owners looking at a city, which you're going to have in a city like San Francisco, the real estate stock is going to reflect their interest. Also, there's a very motivated, environmentally sensitive tenant demand in the city of San Francisco. Google, Salesforce, Facebook, all of these companies that have made this part of what they will commit to for their new recruited employees as organizations they stand for. So the tenant base is demanding this also. And then the final piece where it helps a city get higher numbers is new construction. Almost every big piece of new construction anywhere in the country is following LEED. and so to the extent that you're adding new buildings to the stock, you're going to add higher percentages of green to your overall. So the city of San Francisco has it all: committed community, committed tenants, committed ownership, city and state regulatory requirements, and the like. So San Francisco, you understand why they're there. Our estimation is by next year, San Francisco will be #1 and will take over because, again, there's a lot of new construction going underway, and that will be added to the mix. Well, now we look at the alternative, though, Kansas City. And again, I don't want to be pejorative about this or negative in any fashion. In fact, last year after we did the study, the city of Pittsburgh was actually number 30. And about 3 weeks or 4 weeks after this study came out, I had the opportunity to speak to a USGBC function in Pittsburgh. The Pittsburgh folks were not happy because they felt that we had not really understood the Pittsburgh community well. And so we really tried hard this year to get the local folks to tell us the storyline. But the storyline from Kansas City is almost the reverse of San Francisco. Very old existing building stock. Sometimes older buildings can be very efficient, but they also sometimes have difficulty with it because they're very large lobbies, they don't have efficient mechanical systems, et cetera. So an older building stock can be a detriment. Limited new construction, again, the reverse of San Francisco. They also, we are told by our marketing folks, that there is limited tenant interest. They don't have Facebook, they don't have Google, who are occupying space in Kansas City, so they're not being driven to this by tenant demand. And then conversely, there's then limited ownership interest in making their buildings green if they don't feel that there's the tenant interest that would then give them an economic benefit for having spent the money and time to create green space. Additionally, there is very limited institutional ownership. It is not a global tier 1 city. So they don't have the force of ownership coming in. There is one glimmer of change, however, and that is that literally a week ago from today, last week Thursday, the Kansas City City Council passed on a 12-1 vote a new ordinance that is going to mandate energy benchmarking and disclosure going forward. It was interesting. This was hotly contested. It was not supported by the business community. It was not supported by the real estate community, who had a variety of reasons because of cost and shame, name and shame sort of thing. But also there was a distrust of the motives of the city council from folks who I spoke with. But no matter, they passed it. And it will be interesting for us to follow over time if something like a disclosure requirement leads to better adoption, higher adoption rates of green buildings. So those are the two cities and kind of the yin and yang of this. I'll finish with some takeaways here. And Nils and I have addressed most of these, that basically there is a large variation in adoption of Energy Star and LEED. The leading large first-tier coastal cities are the ones that are doing it first. They're the first movers. There's lowest adoption, obviously, in the smaller second-tier interior cities. It is now a significant piece, and we were quite surprised when we did this last year to see how deep the percentage of square footage was of these buildings, that it was nearly 40% of space, and that came from almost a standing start in the 2005. So very small, or very large percentage of actual space. However, it is a big building phenomenon, and that was one of the new things that we looked at this year. We understood that last year by the ratios, but what it says here is that also if there's 13% that is certified, that means that 87% of space still is not certified or green. So it's very much size matters. We also think that some markets may have reached a saturation point, but also even those markets that are very low, in almost every case, almost all new buildings coming on board are pursuing and gaining LEED NC. So over time, but again, it could take 30 or 40 years, but over time, all new buildings, I think, will be doing green certification. And finally, I think, and this becomes an important thing, and it's part of what we're thinking about what's next. The first movers have moved. The big buildings, the high-profile clients and high-profile cities are there. At one time, 3 years ago, 5 years ago, you could differentiate yourself by being LEED or by being Energy Star labeled. Now it's really almost table stakes. And so people are beginning to understand or seek to understand what is the next iteration, what are tenants and occupiers going to be looking for. And one of the things that we are considering and that we're studying is the whole matter of wellness. It's the whole matter of occupant experience, about what do tenants actually get out of these buildings. And so then what's next? It is our intention to continue to do these studies annually. It is our intention also next year to do it on a global basis, look at probably 25 global cities. We understand that there are differences in the way these are done and different label requirements, et cetera, and it's going to be somewhat difficult to compare apples to Amsterdam. But our hope is that we'll be able to come up with a way to do that and do it on a global basis. And then we're also going to begin to really look at some of the things that are happening, these city and state disclosure rules. A number of cities, I think it's 14 or 15 now, have recently or in the recent past adopted disclosure requirements. We're going to be following those cities in particular to understand, did that make a difference? Is there a higher uptake in those cities now that are pursuing that? We're also going to be looking at what the impact of the higher standards, the more strenuous standards for LEED EB4 will be, if that has an impact on a slowdown of LEED EB, because as Nils pointed out, that has been the most dramatic uptake in the marketplace. And there's going to be some changes in the underlying data set for Energy Star, EPA Energy Star this year. And we're going to be very curious and very interested in following what the impacts of those new base numbers have. We're told, we've had numbers of meetings with EPA and the like, and they're telling us there's going to be minor uptick, minor downtick, but on balance it's going to be about the same. Some of us have more and more doubt that that will be the case and that this really could be a transformational recasting of the baseline, and we will bear that in mind and look for changes in our study next year. So with that, thank you for your attention, and I think the organizers are going to open the line now for questions. Thank you.
Great, thanks, Dave. Really, thanks, Nils, Dave, for the great presentation. Super important research. So we're going to go into Q&A now. If anyone has questions for Nils or Dave, you can enter them in the bottom right corner. We already have some questions coming in, and I just want to answer one of them, which is if the slides will be available following up after this webinar, which they will. In the middle chat window, there's a link to download those slides already. You can also find them if you go to our website, cityminded.org. The home page has an image for this webinar, or you can also find it if you click on calendar on the top menu and you go to the webinar page, the event page. So we'll also be providing the recording from today on that event page in the next 24 hours, 36 hours, so you can find that as well and share that with colleagues. So we already have a couple questions. Brad Malotsky asks, I think this is for you, Nils, given that LEED is now requiring a 75 ES score, and given that a 75 connotes top 25% of normalized market, are you concerned that we are measuring the best of the best and missing the bottom quarter where real energy efficiency movements can really move the needle? That's for you, Nils.
Did Nils leave us?
Uh-oh, are we missing Nils?
Are you on mute, Nils?
He possibly is. Dave, you want to tackle that first?
Sure, and first, welcome, Brad. It's always nice to have a friendly ear, so I hope things are good with you. There's always the concern, I think, that any of these are only to measure the best of. And I think the real opportunity for change is on what I like to call the rest of the mess, which is that 87%, and that's why I made that note. Unfortunately, I think that LEED does just indicate the best and does have, it's only those that are recognized, and the same with Energy Star. I will tell you a side note here. I mentioned some of the other work that we're doing. One of the studies with Cleveland State where we're asking tenant opinions on what is most important to them and which ones they would actually pay for. Part of the underlying reason that we're doing that study is that we are attempting to find a way to measure sustainable access or sustainable attributes in a different way, so that even a building that doesn't have LEED could demonstrate that it had the things. And spoiler alert, the things that we're discovering, and this will be out on a paper this summer, the things that we're discovering that tenants really want don't have anything really to do with recycling or with, with a lot of the ways the buildings are built or whatever. The two things that they find most important is indoor air quality, and that encompasses a wide range of things, and also access to natural light. Those are the only two things that the tenants put above the 1 marks. So they were the ones that they most cared about and were most interested in and would pay for. And so we're trying to figure out a way that a building can demonstrate that it has those kinds of characteristics to the tenant population in a way, Brad, that would not just recognize the stars, but how do we recognize the efforts of the others? I don't know if that truly answers your question, but it is obviously that whole matter of how do we move the bottom up is quite important.
I think we have Nils back. Nils, do you want to add to that?
Yeah. So, well, I actually think that it is important to have this 75% cutoff or a cutoff somewhere to show the market, where the top is. At the same time, I think it is critical to understand that moving a building that's rated 10 or 15 or 25 and moving that to 50 is, in terms of savings, probably even better than the building that is at 75, which might be designed to perform at 75. And there's new financing tools in the market to also address that, and that can help building owners to finance some of these retrofits. And I believe it's important to recognize that at this point, Energy Star, and there's no other tool, is set up to recognize those buildings that have made significant improvements, and that's where a more continuous measure could maybe be beneficial. But maybe also a measure like in Europe, an energy label based on intrinsic performance versus real performance, where you can show as a landlord what you've done to make sure that your building performs better than it was even constructed for.
Great. Thanks, guys. Alexander Quinn is asking either Dave or Nels, have you studied the rent premium of LEED and or Energy Star buildings versus the overall stock?
Yeah, with Dave's permission, I'll take that first. In 2007, we started studying what I call the economics of energy efficiency, the economics of green building. And what we documented, and this webinar is too short to go into all the details, but what we documented is performance differences between LEED, Energy Star on the one hand and non-certified buildings on the other hand. There's always issues, apples to apples. We took a lot of care to control for that. We found differences in rents, occupancy rates, and prices that were pervasive or consistent throughout the crisis, and that actually still continue to persist. So, yeah, I can put numbers on that. We found a rental difference of about 3%, and difference in cash flows of 7%, and a difference in transaction prices of 13%. And shameless self-promotion, but if you look at my website, nielskoch.com, and you go to research, you'll find all the evidence there. But I never think there's enough research. I don't think those point estimates are the full answer. But there has been a large number of studies out there that look at the financial implications. And indeed, there seem to be performance differences, whether it's a green premium or a brown discount.
Great.
I would also add, well, yes, I would add that this is one of the first academic studies that we did was with the University of San Diego with Norm Miller, and we were looking at that issue. That it was back at a time when there weren't a lot of LEED buildings, but we took a portfolio of CBRE managed buildings, 160 plus or minus buildings in 10 markets that all had an Energy Star label, and compared the performance of those buildings against their peer set. And we were able, because it was during the depression of the real estate industry, not a lot of churn in the buildings, and so we actually maintained the management of most of those buildings over a 4-year period, and we're able to do it longitudinally over those 4 years. And there were some ups and some downs, obviously, and over time, more of those buildings became LEED certified as well. But what we discovered is that consistently over the time frame, Energy Star labeled buildings and then ultimately LEED buildings did outperform their market. And there was a market here that it didn't, but broadly, consistently, those buildings did outperform the marketplace. And it was in that 3 to 4% range that Nils had cited. Nils did it much more detailed with a lot more regression analysis and all the things that smart people do. But we did it on what we thought was a pretty consistent basis, and it was, again, part of the fabric of the dialogue that these buildings do tend to be better. Now, there's always a concern that, was that causation or coincidental, because these are better buildings and, they're all managed by, high-profile companies, et cetera, so you never can really test out for all of that. But our findings were that consistently these buildings did, in fact, perform better than their peer set.
Great. Thanks for that. Great. And this question's for you, Dave. Chadwick Macesso asks, how is CBRE working to engage and implement on some of the less than 250,000 square foot tenants and owners? What has been successful?
Well, first, a couple things here. We have mandated for the buildings that we manage of all size, everything over 50,000 square feet, that first of all you do benchmark. Because we think that just the fact of benchmarking and understanding where you are relative to maybe other buildings in your managed portfolio, to clients' other buildings in the marketplace, et cetera, make you strive to do better. And so we start with benchmarking. The second thing that we've done is that we have had a training program. We adopted the BOMA BEEP, for some of you on the call may know that, but it's a training that the BOMA organization created with EPA back a number of years ago. And we, to this day, have a weekly training program on that so that we're sure that our managers and our engineers who are required to take it have done it, so that and part of that then is for them to do a building analysis and to do an energy checklist. So what we want all of our managers to do, benchmark it, understand what to do with it, and then do an evaluation of each of those buildings, and then systematically try to move forward to improve your score. And I don't want to, it just isn't about CB in this call, although obviously everything is about CB on this call, but the reality of it is that our average Energy Star score across our entire portfolio is really quite high. And I think to some degree it's because we have been able to incrementally, bit by bit, improve by just a variety of practices. And I'll just give one idea that we did implemented across the portfolio, and that was the hours of operation. And this seems like a simple thing, but almost every building in America has office hours Monday through Friday and then Saturday. And we were able to go through in almost our entire portfolio and encourage the tenants to give up Saturday hours unless by demand. If they had it in their lease, they needed it, they were going to be there, then call the engineers or arrange prior and we'll turn it on. But rather than running it for 6 hours on Saturday, it was going to be shut off unless someone demanded it. We found we had almost no pushback, and we also found that we almost never have anybody really want it on or have it turned on a Saturday. So that by itself cuts 6 hours out of 66 hours. And there's differences because of demand rates and all the rest. But you can begin to just see those kinds of things just in practice and in how you implement things in a building can make actually a big difference. So I would just start with the simple things first.
Great. There's a lot of questions here about whether size matters. Laura Barks asks, do you have insights? I'm going to combine a few of these questions. Do you have insights into the reasons the adoption of certification is so much stronger in larger buildings? Is it a question of efficiency, of scale? And then Mark Collins also says size matters is likely affected by smaller building owners, managers being less willing to expend resources to gain certifications or believing that it's less necessary in their market space. Is anyone looking at actual building performance? So there's a bunch of questions about size and smaller versus large buildings. Do you want to take that first, Dave?
Sure. First of all, big buildings are typically in big cities, and they're also typically owned by big owners. And both of those kind of, and the final thing is that they're typically occupied by big tenants. And in this world, the people who care about this most are the big cities, the big owners, the big tenants. And they're probably pushed to it in big cities. So, it does, I think to some degree it happens because of that. I don't think it has anything to do with their bigger efficiencies or any of the rest of the stuff. It's just that typically the ownership of these buildings, the tenancy of these buildings and where they're located almost mandates now as a cost of admission that you have to be recognized or you're no longer A class. I mean, in my estimation. And so I would offer that as the first piece. Nils, do you have anything to add to that?
Yeah, well, I would say it is a matter of skill also. If you spend $50,000 on energy in a smaller building, and you can save 20% on that, that's $10,000. That's real money, but at the same time, do you really want to get into the headaches of you don't have to retrofit that asset necessarily, but do you want to get through the headache of the savings, getting the savings and an energy audit and then the implementation for $10,000? Whereas in a big building where you might spend $500,000 or even $1 million on energy, if you save 20% there in terms of absolute dollar volume, well, that might be worth the headache of getting an engineering firm out or getting somebody in the asset manager, the property manager, to think about this. So I do think there is a scale element to this, I also would agree strongly with you, Dave, that big buildings, big cities, big tenants do have an influence, even though there are a lot of institutional owners that would have buildings outside of the big cities. In fact, I was at for example, Prudential yesterday. They're not just in the gateway cities. They also have many buildings, the office parks, the campus-like situations, and they still care about the efficiency of those assets. So, not necessarily the case that small buildings are owned by mom and pops that are less sophisticated or care less about certification or do not have the capital to improve. And I do think that the scalability is a real issue, and it's a good question on how we could get into this further.
One of the things that we've talked about, just one final point on this, is that obviously the study shows that most of the big buildings in big cities, et cetera, have already moved, and very few of the littler buildings. And so part of the thing, that message to take away from here, particularly if you're using sustainability or environmental aspects or whatever as a differentiator, you no longer really have that opportunity in the big building space. But if you're a 100,000 square foot building, 200,000 square foot building in some of these markets, it still could be a differentiator. That you could still be the first building on your block. I mean, you can no longer do that in these bigger spaces. But and we used to always do a press release when we got the LEED EB on this building. It was the first in Atlanta, or there was the first gold, there was the first this, or the first on. Well, there's no more of that. But there's still that opportunity for some of these smaller buildings in smaller cities that they could capture that high ground. And that's one of the things that I take away from this, that some of these smaller buildings may be still first in their class to do that and separate themselves from some of their competition.
Great. And I'm going to throw in my own question because I'm very curious. It seems, Nils, maybe you can answer this first. There seems to be a sharp increase in adoption during the recession, which seems counterintuitive. Is there a causal relationship between how the economy is doing and green building adoption, or is that just a coincidence?
Well, I would say if anything, there's a negative relationship between the two. If there's a lot of liquidity, that doesn't necessarily mean that the interest in sustainability is increasing. As investors do not have much of a choice on where to invest, but they just have to invest. But I don't think we can really talk about correlation or causation here. What you see is that, let's say, as of 2005, call it the green building movement, but I would say the global interest in sustainability, especially in real estate, has been increasing. And interestingly, that really started to pick up during the crisis. There was also a period when institutional investors, the pension funds, et cetera, that invest in real estate got much more leeway or an ear at their investment managers and the REITs that they invest with, given that, when times are bad, you need your investor, and when times are good, you can get a lot of money. So I definitely think that helped in driving ESG further. I call it ESG, environment, social governance, or sustainability further into the real estate market. I wouldn't call that causation. I think it's more a lucky correlation.
Yeah.
I would add one thing to this too. That LEED EB, there was a change in what LEED EB was and what it became around the 2008. I don't recall the exact time frame. That we started getting involved with a group that was going to do LEED EB certification internally, and we had met with the USGBC. And at that point in time, there were fewer than 60 LEED EB buildings in the world. And LEED EB at that time was really almost a recertification, a secondary recertification for the building that had been built to LEED NC standards. So LEED EB standards had a lot of the characteristics about how the building was built, where it was built, and those kinds of things. And then there was a dramatic change in the standards and the protocols for LEED EB around 2008, 2009. And I think that's what's shown this dramatic uptake. So these buildings that were able first to only show that they were energy efficient with Energy Star, now are able also to embrace the full LEED EB portfolio of changes and ideas to demonstrate that across the board they were environmentally sensitive. And so that's why I think LEED EB has totally taken off. And you can see the numbers, that the number of LEED EB is significantly higher than LEED NC. Had they not made that change to open it up to the world that even didn't have LEED NC, I think we would have seen a much smaller uptake of that.
Great. So I'll have this be the last question. We didn't get to a couple of these questions, but we're going to send these questions to Nils and Dave and if they have time, they can answer them on our blog as a guest blog post on our website. So we'll just put pressure on them publicly to do that. But one last question. Otto Dahl asks, does Minneapolis do anything specific beyond what San Francisco does in being able to be rated the greenest city?
One thing that I would add and that we discovered last year, there is a true community concern. Minneapolis, and again, I wasn't really as aware of this until we got involved in this, there's a true kind of, it's part of it is the outdoors and taking care of nature and the environment, and that really seems to be embedded very much in the Minneapolis culture. And so I think that is one. There also is a much higher concentration of corporate headquarter buildings or headquartered companies in Minneapolis than we were aware. And now that also drives, because these are the folks that are reporting out. And just one thing that we didn't talk about here is that in fact, if you looked at the Fortune 500 and you read their CR reports, many of them use sustainable real estate and their occupancy in labeled properties as one of the demonstrated ways that they care about sustainability broadly, environment broadly. So they will seek and occupy only labeled buildings. So to the extent that a city like Atlanta or like Minneapolis has a high concentration of corporate headquarters, this tends to then change a little bit the attitude about what the real estate wants to be, because these people, if they're going to occupy space, these companies, they're going to want to look for green space. And again, a marketplace, there's a dynamism to a market that once 2 or 3 or 5 of the buildings that are your competitive set are gaining this, then you need to gain it. You can first use it as an advantage, but then pretty quickly, if you're not part of that, it becomes the brown disadvantage that Nils described. So I think that there's something about that once something begins and there's a pace to it, then all the buildings have to join in. And I think the overall community spirit around environmental practices in Minneapolis and this concentration of corporate headquarters are at least 2 of the things that were pretty important.
Fantastic. Okay, amazing. Thank you so much, you two, for a fantastic presentation. Great new data and research being done by you both. And so we're gonna conclude with that today, and a reminder that a short survey will pop up when you close your browser. We really appreciate all of your feedback, and we hope to see you on our blog at cityminded.org. We'll let you know if we are able to extract a blog post from Dave and Nils, the busy guys, and hope to see you at our monthly webinars and our annual summit in October in the Bay Area. So have a great day, and thanks again. Thanks, Nils and Dave. Fantastic webinar.
Thanks for the opportunity.
Thank you.
Bye, everybody.